My name is Daniel Brown and I'm the CEO of Myriad at my home group and a licensed realtor here in Phoenix. This is our market update for May 2020, but before we start, if you wouldn't mind giving this video a like and subscribe, I'd really appreciate it. Currently we have 14,000 homes listed for sale in the greater Phoenix area versus 17,500 this time last year. This is down 20%, but we're actually up 6.5% from this time last month, which is actually good for buyers. It means they have more choices. Homes under contract or pending are currently at 9,500 versus 12,500 last year. This is down almost 24% and down 6.3% from just over 10,000 homes under contract last month. This shows the steep drop off in buyer demand we had in the month of April due to the stay-at-home order. And this was all to be expected. Sales are still taking place though, as we currently closed 7,100 transactions. This is down from the 9,600 we closed this time last year, which is a 26% drop off, and we're down almost 20% from 8,800 closings last month. Our average monthly sales price per square foot is $184.24 versus $172.24 last year, which is actually up 7% from this time last year, but we are down a little bit, 1.3% from last month. Monthly average sales price for the greater Phoenix area is just under $1 under $300,000 versus $270,000 last year. This is up a whopping 11% and only slightly down from $301,000 last month. So what does all this mean? Well, supply went up while demand came down. Sales in greater Phoenix dropped, causing prices to weaken some. This all seems bad, but the drop in prices is mainly due to the natural summer pullback we see in the luxury home market. Our wealthier residents either leave town for the summer and pull their homes from the market, or just pull their homes from the market in general. This happens every year and is very predictable. Sales pricing will continue to look a little weak for the next several months because of this. Less expensive sales equate to a lower average sales price and a lower price per square foot. So don't believe all the clickbait headlines that you're gonna see saying that prices are falling in Phoenix quite yet, because they really aren't. At the beginning of April, we did see a rise in active listings, which has now flattened during the first part of May. This rise was due to several factors. We saw some vacation rentals hit the market early on. Remember, everybody canceled all of their trips to Phoenix because all the stay-at-home orders came out. We saw homes that were under contract fall out of contract due to panicky buyers or buyers who lost their job. We also saw all the iBuyers or institutional investors like Opendoor, OfferPad, and Zillow completely leave the market. Anyone they had under contract, they pretty much bailed on. Some of these homes were then listed the traditional route. All of the chaos that COVID-19 and the stay-at-home order has caused has since really leveled off, and we now have stabilized at a level of around 20 to 25% below normal. It's reasonable to believe that May should see less volatility as both supply and demand hopefully continue to stabilize. It seems people are feeling more comfortable as we settle into our new normal. I've been comparing this to the 5 stages of grief, and a lot of us, including myself, are now at that acceptance stage. I think that's why a lot of states, including our own, are starting to open back up next week. I think this is a good thing because I'm in desperate need of a haircut. The only city that is currently in a balanced market between buyers and sellers and currently has the potential to actually drop into a buyer's market is Paradise Valley, where all those luxury, wealthier residents are. So if you have millions of dollars to spend, now might be the perfect time to do it. All other cities remain in a seller's market. The seller's market we're seeing though isn't as strong as it once was. We are seeing sellers more willing to negotiate on price, concessions, and repairs versus where we were just 6 weeks ago. There are buying opportunities all across the entire market. I think people are recognizing this as buyer demand has actually doubled over the last 2 weeks. So we were on this steep decline and it's since leveled off and we've actually started to rise a little bit. I'm even seeing this in my own business. We're very buyer heavy right now due to the slight shift in power from sellers to buyer. And don't forget, mortgage rates are insanely low right now. Did you know it's actually cheaper on a monthly basis to buy a $250,000 home today at a rate in the low 3s than it was to buy a $170,000 home at a rate in the mid 5s? These rates are fantastic and hovering right around the target rate of inflation. With how much the Fed is pumping money into the system, we could see inflation much higher than the target rate of 3% in the coming years. If you're at a fixed rate in the mid threes, it's like free money at that point. This shift in power is wavering though as more buyers are returning to the market. So a lot of people are bringing up the word forbearance. Let's talk about it. Only 7% of mortgage holders filed for forbearance on their mortgages since the COVID-19. This is pretty low, all things considered. Fannie Mae and Freddie Mac, which back a little over half of all mortgages, just came out and said they are not going to make these mortgage payments due all at once either. Just for a little context, when someone is granted a forbearance, let's say for 90 days, this means they can skip up to 3 months worth of their mortgage payments. However, on the fourth month, all 3 months that they skipped plus the fourth month are due immediately. That's a hefty payment to make all at once. Fannie and Freddie, because they are owned by the government, have stated they will not make all this money due at once. Usually, when Fannie and Freddie make a move like this, all other lenders and servicers tend to follow because of the enormous pressure put on them. Because of this, I do not think that we're going to see a flood of foreclosures hitting the market. No one, including the banks, wants a repeat of 2008, and I don't think we're going to see one. This goes without saying, that not to mention people have so much equity in their home right now based on when they bought it, that if they are in financial trouble, they should just sell their home, take their equity, and rent something cheaper until they get back on their feet. The housing market is in such a better place than it was leading up to 2008. And remember, the 2008 crisis was actually caused by the housing market. This is caused by the forced shutdown of our economy due to a virus. These are very different circumstances. So I'm going to continue to monitor the housing market and bring you updates as we get them. Thank you so much for watching our video. If you have any questions or need anything, absolutely reach out. And please continue to stay safe and healthy.